Dutch Lady is one of the leading dairy manufacturers in Malaysia that was founded in 1963 and listed on Bursa Malaysia on 1968. The company operates under Royal Freshland Campina, which allow it to leverage global expertise, advanced technology, and nutrition research. Overall, DLMI focus on providing high quality and halal certified dairy products to support nutrition across different life stages. The dairy product can be divided into four main categories. These categories reflect how the company address different consumer needs, from everyday household consumption to more professional use. You can see example on this slide. This structured product approach allow DLMI to serve a wider Looking market. At its financial performance, DLMI shows steady growth. Although profitability was pressured during the transition period, it was temporary. Once major operational changes were completed, their performance improved. This highlights the importance of efficiency and innovation in supporting long-term sustainability. In response to changes in business environment, Dutch Lady also adjusted its strategy over time. The table shows a clear shift from short-term resilience toward long-term efficiency and modernization. This culminated in the move to a highly automated Industry 4.0 facility, which reflect how DLMI use technology to improve efficiency, support sustainability, and prepare the business for future
Let's
use.
look into Dutch Lady liquidity ratio. In 2021, company reached its peak liquidity where current ratio is 1.59 and a quick ratio is 1.05. This suggests excellent short-term solvency post-pandemic. In 2021 to 2023, we see a steady decline, and then by 2024, the current ratio fell to 0.84 and cash ratio fell to 0.81. It showed that current liability now exceed current asset, which means heavy reliance on inventory and stable cash flow to meet obligations.
Overall, the company's operational efficiency declined over the 5-year period. Inventory turnover fell from 4.92 times to 4.04 times in 2024, while inventory holding days increased from 74 days to over 19 days, indicating slower inventory movement. Total asset turnover also dropped significantly, showing weaker asset utilization. Receivable management was mostly stable, with collection periods averaging around 24 to 27 days. Although this increased to 31 days in 2024, it shows slower customer payments. At the same time, the average payment period extended from 145 days to 186 days, suggesting that management relied more on supply credit to manage cash flow. To conclude, the company prioritized liquidity management rather than operational efficiency.
So for the leverage ratio, in 2022, the debt to equity ratio peaked at 1.99, showing heavy reliance on liability. However, this was halved by 2021 and has since stabilized around 1.15. This reflects a move towards a more balanced and sustainable capital structure. Most impressively, the time interest earned ratio surged to 358.02 by 2022. This massive leap confirmed that the company profit recovery has significantly strengthened its ability to service debt.
In terms of profitability, the company performed strongest in 2021, where gross profit margin peaked at 35.26% and net profit margin reached 21.87%. However, 2022 marked a major downturn, with gross margin dropping and net profit margin falling sharply to 3.45%, mainly due to rising cost pressures. Although profitability recovered gradually in the next years, margins did not return to their 2021 peak. This trend is also reflected in shareholder returns, where ROE declined from 2021 to 2022 before improving to 19.26% in 2024. Overall, profitability remains positive but highly sensitive to cost fluctuations.
So for the market ratio, our PE ratio spiked to 42 times in 2022 due to earning pressure, but has now corrected to a healthy 20 times. Most importantly, our book value per share tripled from 2 ringgit 63 cents to 7 ringgit 84 cents, showing consistent growth in equity. While the market valuation has cooled since 2022, the slight upstick in 2024 confirmed that investor confidence is returning as our earnings
Next, cost of
stabilize.
equity. We use CAPM to calculate cost of equity. By applying this formula, we get 3.29% of cost of equity, and it is lower than the risk-free rate, which is 3.57%, because of the abnormal market conditions that happened during 2020 to 2024, such as COVID-19 pandemic that causes earnings volatility and affect beta. The beta is estimated at 0.2053, and it means low sensitivity of Dutch Lady to market movements. When the market moves by 1%, the stock of Dutch Lady moves by only 0.2053% on average. And it indicates that limited exposures to systematic risk, and less volatility due to the defensive industry characteristic, empirical market behavior, and even the portfolio role. Next, 3.57% of risk-free rate represent a normal baseline return expectation, and it avoids distortion caused by short-term monetary shocks. Ups and downs impact heavily by some factors such as COVID-19 pandemic, monetary volatility, aggressive inflation rate hikes, process of stabilization. And also, the market return proxy is estimated at 2.21%. It is quite low and shows the heightened risk aversion, and their capital allocation tends to be defensive stocks, not growth-based equity.
Next, I will explain Dutch Lady's cost of debt and its weighted average cost of capital, WACC. So starting with the cost of debt, Dutch Lady's cost of debt before tax is 8.92%, which indicates that the company is paying a relatively high interest rate on its borrowings. However, because interest expenses are tax deductible, so the cost of debt after tax decreased to 6.78%, which reduced Dutch Lady's actual financing burden. Moving on to WACC, so Dutch Ladies WACC is estimated at 3.42%, which considered low. So this shows that Dutch Ladies has a low overall financing cost and relatively low financial risk. The capital structure is heavily weighted towards equity. Therefore, although the cost of debt before tax is relatively high, its impact on WACC is small because of the tax deductions and the very small proportions of debt in the capital structure. Overall, Dutch Lady's equity-heavy capital structure is optimal and economically rational, aligning with its low-risk and stable business model, and it indicates that Dutch Ladies is appropriately financed rather than
Moving on to the
under-leveraged.
security market line, this is the SML graph that we generate based on the calculation and the number we get. It is downward sloping SML and slightly different because of the negative market risk premium. Expected market return, 2.21%, was less than the risk-free rate, 3.57%. So taking more risk did not pay off. Dutch Lady security are fairly valuated for its level of risk under prevailing market conditions, and it means investors are willing to accept a return that is close to the risk-free rate due to its earning stability and defensive nature of Dutch Lady. Overall, Dutch Lady offers stability rather than excess returns, providing investors with a low-risk capital preservation investment within their portfolio.
In conclusion, the financial analysis of Dutch Lady shows a mixed performance over the 5-year period. The company recorded its strongest liquidity position in 2021, likely due to careful financial management during uncertain economic conditions, but weakened in subsequent years due to increased pressure on short-term financial resources. Operationally, we have noticed some inefficiencies, specifically with slower inventory turnover and longer holding periods. This suggests that there is less efficiency in asset utilization. On the other hand, Dutch Lady maintained a stable capital structure with moderate debt levels. The improvement in covering its debt further demonstrated a strong recovery of their profit performance. Besides, Dutch Lady reached its peak for performance in 2021 and followed by a sharp drop in 2022 due to rising costs. Market ratios also indicate a gradual improvement in investor confidence by 2024, although valuation remained affected by earning volatility. From a cost of capital perspective, Dutch Lady has a relatively low weighted average cost of capital at 3.42%, indicating the company is well protected against systematic market risk. Looking at the security market line, Dutch Lady shares are currently fairly valued, which offering a low risk capital preservation path. So, what is our conclusion then? We recommend a hold. The low beta makes it perfect for preserving the capital, and the stock is fairly priced for its risk level. Although the company is financially stable and low risk, its profitability has not yet returned to its 2021 peak. Investors should hold the stock and wait for further improvement in efficiency and margin before considering additional investment.